After years of blistering rent hikes that left renters gasping, 2025 has suddenly become the year when landlords start to break a sweat. If you're renting, or even thinking about renting, this could be one of the biggest shifts in living costs in a decade. Once unassailable rental rates now sliding, vacancy signs up, and cities across America emerging where rent is collapsing, forcing landlords and property managers into a scramble. In the next few minutes, we'll walk you through the U.S. cities and markets where rents are falling the fastest in 2025. We will give you the inside scoop on what it means for renters and landlords who never saw this coming. Whether you're a renter scouting for deals, a landlord trying to gauge risk, or simply someone curious about the rental market, you'll want to stay locked in. Because this isn't just about a few bucks off your monthly payment, it's about shifting power in the rental economy. Before we dive in, don't forget to subscribe to our channel. Atlanta, Georgia. Another city facing a come-down is Atlanta, Georgia, where rents have also dropped about 13.6% from peak levels, mirroring Las Vegas. Once the darling of post-pandemic relocation trends, Atlanta saw an explosive influx of new residents from the Northeast and West Coast between 2020 and 2023. Developers rushed to keep up, erecting thousands of new multifamily complexes across Fulton, DeKalb, and Cobb counties. But by mid-2025, the tide began to turn. Apartment construction outpaced population growth, and the influx of supply finally caught up to years of demand. Pair that with a slowing job market, particularly in tech, logistics, and real estate, and you get a city where landlords can no longer command premium rents. What makes Atlanta's drop so significant is that it challenges the narrative that growth cities are bulletproof. Even though Atlanta's metro economy remains strong overall, the rental sector has overshot. For the first time in nearly a decade, renters can shop around and find move-in discounts, upgraded amenities, or short-term leases at lower rates. This isn't a collapse but a correction, and possibly a healthy one. With affordability improving, Atlanta may attract new talent again, balancing out the extremes of the pandemic boom. But for landlords who bought at the top, 2025 is testing just how resilient the Sunbelt investment story really is. Las Vegas, Nevada. No rental story would be complete without talking about Las Vegas, a market that once symbolized the pandemic-era migration boom. During 2020 to 2022, Vegas became a magnet for Californians seeking lower costs and better weather. Rents soared by double digits, investors piled in, and luxury apartment construction exploded. But by 2025, the tables have turned. Las Vegas rents have fallen 13.6% from their pandemic-era peak, one of the steepest drops in the nation. The culprit? Oversaturation and cooling migration. With thousands of new apartments hitting the market and fewer remote workers relocating, landlords are finding themselves in unfamiliar territory, offering move-in specials, free months, and even gift cards to attract tenants. Another factor at play is the economic slowdown. Tourism and hospitality, two of Vegas's lifelines, have been fluctuating amid broader economic uncertainty. With household budgets tightening, renters are downsizing or moving in with roommates, reducing demand for expensive one-bedroom units. In short, Las Vegas is experiencing the natural hangover after the boom. What went up too fast had to come down. For renters, it's finally a breather, and possibly the best time in years to negotiate. For landlords and investors, it's a harsh reminder that the Sun Belt isn't immune to oversupply or shifting migration patterns. Providence, Rhode Island. Next up, Providence, Rhode Island, one of the most striking examples of rent collapse on the East Coast. Here, average rents plunged by a staggering 19.22% year over year, from $2,513 to $2,030, nearly one-fifth wiped off average rent in just 12 months. The story of Providence is both local and systemic. The city, long known for its beautiful historic architecture and tight rental inventory, decided to take a bold step. It loosened its housing regulations, streamlined the permitting process, and encouraged adaptive reuse, turning unused commercial buildings and older factories into livable apartments. It also incentivized developers to pursue higher density projects near public transit, creating thousands of new units in areas once zoned for single-family homes. At the same time, demand cooled. The pandemic boom that drove renters from Boston and New York into Providence slowed sharply as remote work contracts ended and people returned to larger metros. That combination, falling demand and a growing housing supply, triggered one of the biggest rent corrections in the country. For renters, Providence has become something of a case study in how policy can work fast when it's aimed at real affordability. For landlords, however, it's a jolt. The city's once tight rental market now has competition. In 2025, renters can shop around, and landlords are offering discounts and upgrades just to keep occupancy high. Other aging mid-sized metros, from Albany to Hartford, are watching Providence closely, wondering if its housing-first reforms could finally offer a path to affordable living without killing investment. Minneapolis, Minnesota. When you think about places where rent collapses, you usually imagine fast-growing coastal cities or overheated Sunbelt metros, not the stable, sensible Midwest. And that's what makes Minneapolis such a fascinating case study in 2025. Rents here declined by roughly 6.3% year over year in May, signaling that even steady markets are feeling the national cooling trend. What's happening in Minneapolis is a mix of both local policy and macroeconomic pressure. Over the past few years, the Twin Cities region became one of the first in the U.S. to experiment with progressive zoning reform, eliminating single-family-only zoning, allowing for more duplexes and small, multi-unit buildings in established neighborhoods. That decision, once controversial, is now paying off. As new housing stock comes online, vacancy rates have climbed, giving renters more leverage and pushing landlords to compete on price again. There's also a shift in renter behavior. During the pandemic, many people fled urban cores for suburban or rural areas. Now, as remote work normalizes, some are returning, but with tighter budgets. Add in inflation fatigue and rising living costs elsewhere, and you've got a city where renters are price sensitive and landlords can't simply hike rent like before. For years, analysts called the Midwest recession-proof or stable, but 2025 proves that even heartland housing markets are tied to the same forces as everywhere else. More supply, fewer bidding wars, and the gradual correction of pandemic-era rent spikes. The lesson from Minneapolis? If you build more housing, rents will eventually fall. Austin, Texas. If there's one U.S. city that perfectly captures the volatility of America's rental market, it's Austin, Texas. Once one of the hottest metros in the country, Austin became synonymous with tech migration, skyrocketing rents, and relentless construction during the 2020 to 2022 boom. But in 2025, the story has flipped dramatically. Austin's median asking rent fell 8.8% year over year, landing at $1,385 in May 2025, the city's lowest median rent since February 2021. That's a remarkable shift for a city that, just a few years ago, couldn't build apartments fast enough to keep up with the influx of remote workers, tech professionals, and investors pouring in from California and beyond. So what happened? In a single word, supply. Austin's housing pipeline has exploded. The city approved around 64.5 new multifamily units per 10,000 residents, the highest construction rate in the entire United States. That relentless pace of development, combined with slower population growth and cooling demand, has tipped the balance firmly in favor of renters. It's simple economics. When supply surges faster than demand, prices fall. Developers race to capitalize on Austin's boom years, completing tens of thousands of new apartments in record time. But by 2025, many of those projects are hitting the market simultaneously, leading to rising vacancy rates and a wave of rental concessions. Things like first month free, reduced security deposits, or free parking for a year. This oversupply comes at a time when the local economy is recalibrating. Some of Austin's biggest employers, especially in tech and startups, have slowed hiring or downsized. Meanwhile, higher interest rates and inflation have made renters more cautious. As a result, the once red-hot demand for luxury apartments is softening, leaving landlords with empty units and shrinking pricing power. For renters, this is welcome relief. Austin hasn't been this affordable in nearly 4 years. Apartment hunters now have leverage they haven't seen since before the pandemic. For landlords, however, it's a sobering reality check. Many built their portfolios expecting endless growth. Now they're cutting rents just to fill space. Industry analysts say this marks a normalization, not a collapse, but it's hard to ignore the irony. The same forces that made Austin a symbol of housing demand, growth, construction, optimism, are now the very ones driving rents downward. In Sarasota, Florida. And then there's Sarasota, Florida, arguably the most dramatic rental market story in the entire country this year. According to local housing data, average monthly rent in Sarasota collapsed by a staggering 42.67% from $3,290 in January 2024 to just $1,886 by January 2025. That's not just a price correction, it's a structural reset of the local housing market. To understand what happened, you have to look at policy, timing, and scale. Sarasota, located along Florida's Gulf Coast, had been battling one of the steepest affordability crises in the state. Between 2020 and 2023, the area became a magnet for retirees, digital nomads, and remote workers escaping larger cities. Rents shot up nearly 60% in just a few years, pushing many longtime residents to the brink. But by late 2023, city officials decided enough was enough. Sarasota implemented sweeping pro-housing reforms, including zoning deregulation, density bonuses, and a $40 million investment in affordable housing initiatives. The city also streamlined its permitting system, making it faster and cheaper for developers to bring new housing to market. The results were dramatic. By mid-2024, a wave of new construction and repurposed housing projects began hitting the rental market just as demand started to soften. Wealthier remote workers began migrating elsewhere as cost of living advantages waned, and the seasonal influx of renters slowed. That left the city with more units than renters, a reversal no one saw coming. Within months, vacancy rates soared, and landlords started slashing prices to attract tenants. Real estate agents reported a surge in listings, offering move-in bonuses, flexible leases, or months of free rent. Even luxury developments were dropping prices by 20 to 30% just to stay competitive. The shift has been so intense that local media began calling Sarasota the ground zero of Florida's rent correction. But for residents, it's a long overdue correction that's finally putting the dream of affordable housing back within reach. What makes Sarasota's story particularly important is that it shows policy works. When cities actively remove barriers to housing development, supply can rise fast enough to reshape affordability. The combination of zoning reform plus supply surge plus cooling demand created a perfect storm that not only stabilized rents, but reversed them completely. For renters, Sarasota 2025 is a success story. For landlords, it's a wake-up call. Many who invested during the boom are now watching profits shrink, some forced to offer discounts or reconsider short-term rental models entirely. In short, the bargaining power has flipped. The phrase "landlords are panicking" isn't hyperbole. It reflects real market stress. Sarasota's rental market is now a textbook case of what happens when years of unchecked rent growth meet aggressive pro-housing policy and construction momentum. But here's the twist. Economists believe this correction will stabilize the market long-term. With prices now more in line with local incomes, Sarasota could see a healthier, more sustainable housing ecosystem in the years ahead. One of the most dramatic stories in the rental market this year is in Sarasota, Florida. According to a recent analysis, rents there collapsed 42.67% from January 2024 to January 2025, dropping from about $3,290 per month to roughly $1,886 per month. What's behind this jaw-dropping dive? Pro-housing reforms played a major role. Zoning deregulation, higher density allowances, and significant investment into affordable housing. The narrative here is supply unlocking meets policy push, and renters are benefiting big time. For landlords in Sarasota, this kind of drop is akin to seeing the floor fall out from under you. With vacancies increasing and new inventory flooding the market, the bargaining power has shifted. Sunbury, Pennsylvania. Sunbury, Pennsylvania is a smaller city that rarely makes national housing headlines, until now. Here, average rents declined roughly 6.73%. For a community of fewer than 10,000 residents, that's a substantial drop. Sunbury's rent decline reflects broader demographic and economic shifts in small-town America. As remote workers trickled back to major cities and pandemic-era demand faded, smaller towns that briefly saw a rental surge are now feeling the after effects. Meanwhile, local developers, who built to meet that short-term demand, suddenly find themselves with too many units and too few renters. Yet there's a silver lining. Lower rents could reinvigorate smaller Pennsylvania towns, drawing back younger residents and families who were priced out of larger metros like Philadelphia or Harrisburg. It's also a signal that rental rebalancing is happening everywhere, from major coastal hubs to the Appalachian foothills. For renters, Sunbury's story shows that opportunity doesn't just exist in headline-grabbing metros. Affordable housing is spreading into overlooked markets too. Athens, Ohio. While big city headlines dominate the conversation, smaller markets like Athens, Ohio are quietly undergoing some of the sharpest corrections. Athens rents have fallen around 8.51%, bringing the average rent to roughly $802 per month, a dramatic shift for a college-driven economy. The local dynamic here is different, but equally telling. Athens, home to Ohio University, saw rents spike between 2020 and 2022 as remote classes ended and students returned in droves. Property owners, expecting demand to stay high, raised rents aggressively. But in 2025, that trend reversed. Enrollment numbers stabilized, new off-campus housing opened up, and students began to push back against unaffordable leases. It's also part of a larger pattern in college towns nationwide. As affordability crises spread, many smaller communities have accelerated construction or eased restrictions on shared housing. Athens, for example, approved several mid-rise apartment complexes aimed at students and young professionals, which boosted inventory just enough to push rents downward. For renters, and especially students, this drop is tangible relief. For local landlords, it's a reminder that even in tight college markets, competition is returning. The rental pendulum is swinging back toward equilibrium. So what's the big takeaway from all this? The 2025 rental market is rewriting the rules. For the first time in over a decade, renters, not landlords, finally hold the upper hand. From Sarasota to Austin, Providence to Minneapolis, and even smaller college towns like Athens, Ohio, rents are actually falling. If you found this breakdown helpful, don't forget to like, subscribe, and turn on notifications. It helps a lot and keeps you in the loop for the latest housing and real estate trends.